Hostem speciálu vítězného portfolia je hlavní tržní strateg BNP Paribas Asset Management, Daniel Morris. Daniel, welcome. It's great to see you again.
Likewise.
Let's start, at the beginning of the year in particular. First we had a correction on the stock market, then the stock started rising again, and now we're tackling the historical heights, at least the S&P 500 and Dow Jones. So what did it tell you? What shall we expect this year?
Well, I have to admit the more recent rally, I would say, is the more surprising bit. I mean, the end of the year rally, Santa Claus rally, as sometimes it's called, anticipated that was at least possible. And then beginning of the year, the hangover after all the festivities. So all of that kind of went to plan, not so much a surprise. The rally we've had since is surprising only insofar as at the same time you've had interest rates going up, real interest rates, and in particular expectations for the Fed. So what's surprising then about what we've seen in the equity market is the pattern more or less over the last couple of years is when expectations for policy rates from the Fed go up, equities tend to go down, and particularly we see this in tech stocks. What's happened over the last week or so? Well, it's a bit the opposite. That correlation has broken down. We've had this increase in real rates, whereas the rally we've had in equities has been almost entirely driven by the tech sector. Most of the other markets in the US, most other markets globally have actually gone down. So the real question we want to answer here is, why is tech going up when the other parts of the market are going down and rates are going up? And then we come back to that most fundamental thing, earnings. We've had good earnings news. We are in the midst of the earnings season. There was particularly good news around the semiconductor sector. So that's kind of overwhelmed, if you will, perhaps only temporarily, the impact that you would expect because of interest rates.
You've mentioned earnings season, so let's dive right into it. It's in full swing. How did you read the numbers we got so far? Anything very interesting in particular, surprising? For good or for bad?
Yeah, surprising, no. Now there's the surprises, which are how earnings come in relative to expectations. This is a bit of a game because what you see is before most any earnings season, you'll see expectations for earnings going down. Because companies tend to be, want to be a bit cautious. But when they actually announce the results, of course, they want a positive surprise. So even though you've had previously negative earnings revisions, the actual numbers almost always tend to come in a bit better, and you hope for a bit of a gain in the stock prices. And frankly, more or less, that's the pattern that we've had. Earnings are a bit better than expected, not extremely so, not disappointing. So I think it's turning out so far at least to be a reasonably good earnings season, say not necessarily so far from an average that you would expect, meaning positive earnings surprises. And then also, and this is, if anything, even more important, of course, when the companies announce their results, that's at this point history. We're talking about last year, and we're always, equity markets, always focused on the future. So we look at the guidance that companies give. Are they raising their forecasts for the year? Are they lowering them? And in general, even though it's a smaller percentage, historically only about 25% of companies will actually increase their guidance, but that's the rate that we're getting now, if not a bit better than that.
Right. When it comes to those companies that are still going to report, which ones are you going to follow the closest, if you will? Is it going to be the Magnificent Seven or tech stocks you've already mentioned, or something else?
Well, I think it's always good when you think about the U.S. and kind of want to say is think about it like two countries. In the same way we have different country allocations, you should kind of think about the U.S. as kind of two countries. There's the tech U.S. country and then everything else. So given how much tech has driven, you mentioned Magnificent Seven, but of course tech more broadly really was what performed last year. Therefore, expectations all the higher that price performance is going to be justified subsequently by earnings. We're very much going to watch what the actual earnings results are for the tech sector. And then, of course, what they predict for the future. I'm relatively confident that the market will be satisfied with that, though always, given the enthusiasm we had last year, some potential for disappointment. But by and large, I think the outlook is good. Conversely, if you look at expectations For the rest of the market, it's actually negative, meaning earnings are supposed to be negative year on year. But if that's expected, it shouldn't be a surprise. And also realize that a lot of that negative earnings performance is very concentrated in commodity sectors because, of course, oil prices, for example, are lower now.
One more question regarding or tackling tech. Last year it was not completely, but to a very large extent about technological stocks and aforementioned Magnificent Seven. Do you expect the rally to continue in this modus operandi, if you will? Meaning, is it going to be almost all about technological stocks and related stocks this year as well? Or can we see the rally broadening into the earth across the market, which of course would make it stand on a really solid or much solider footing, if you will?
Yeah, absolutely. Well, again, taking the market separately, I think the outlook for earnings for tech stocks over the medium term, frankly, I think is pretty positive. What we need to pay attention to perhaps a bit more are valuations, because that's really where you can get tripped up with tech stocks if valuations just get too high, regardless of the earnings. You know, at some point that's going to matter. And right now, frankly, valuations for the tech sector are a bit above average, but not excessively so. So for the most part, you know, still think the outlook is good. Last year, as you pointed out, the other parts of the market suffered more. Also with tech, partly a function of the increase in interest rates that we've had, but this year we expect to see declining interest rates. So certainly that will benefit tech, but should also be better for the other parts of the market. That said, we want to remember in the more value sectors, financials are a big part of that, which is going to be sensitive to interest rates. And then also, of course, we need to know what's going to happen with commodity prices, and that's rather challenging to predict.
When it comes to Europe, the earnings season is going to start in Europe as well. What do you expect? Most market commentators are not very optimistic, let's say. Yeah. Is the divergence between the US, both economy and market, and Europe going to essentially widen? Or what do you expect? One more time.
Well, actually, interestingly, the divergence should narrow a bit, and this is probably one of the relatively few good things you can say about the outlook for Europe this year. The story last year was, ultimately kind of accelerating U.S. growth and decelerating European growth, and depending on the country, either in a recession or close to right now. For 2024, that dynamic at least should reverse, and that Europe should be recovering, albeit fairly slowly, but still getting better. Whereas in the US, we really now should see a proper deceleration of growth. And to be honest, at times, I'm sure we'll hear the recession word again as we wonder whether or not that deceleration is going to go too far. So from that point of view, the dynamic is certainly much better for Europe than for the US compared to last year. Now, whether that's going to translate into outperformance in the equity market, frankly, we're skeptical.
Is it, when it comes to macro picture, is it going to be all about rates, or is it something else that you recommend to follow? Of course, rates will be important, but maybe there's something that we're omitting.
Well, it's a very perceptive question, because what's been so unusual about the equity markets over the last couple of years is how important interest rates have been. Now, of course, interest rates are very important. But it shouldn't be the primary driver of equity prices, really. Equity prices should depend on earnings. It's earnings. But that kind of has not been the case. I mean, the earnings outlook for equities for the most part over the last couple of years has been pretty solid. But of course, equities have been much more volatile than that as a function of interest rates. So that balance has been unusually higher for interest rates. This year, we would like to see that go back a bit more towards historical norms, which is that really earnings should matter more. Given though that we're still focused on what the Fed's going to do and how much they're going to cut, interest rates still going to matter. But they should matter hopefully in a more supportive way, i.e. interest rates will be going down. And then once we do eventually get to whatever neutral or the terminal rate will be for Fed funds in the US, then it is really the turn for earnings to matter even more and back to where they normally do historically.
Right. From this perspective, how do you read the speculations about the difficulty of the so-called last mile in the fight with the inflation? Meaning that maybe, even though the inflation decreased significantly, the last bit we still need to fight is ahead of us might prove to be the most difficult.
Well, essentially what we're talking about are the risks to what the market seems to be assuming is going to happen. So our base case, or what the market seems to be assuming, is a soft landing, i.e. you get back to 2% core inflation in the US like the Fed wants, but without having to go through a recession. So that's more or less what the market has priced in. So now what are the scenarios where that doesn't happen? So one is even a bigger slowdown in growth and recession, maybe, doesn't look very likely. The alternative then is that inflation doesn't slow as quickly as the markets are assuming. And we probably share exactly that concern. I think you're right that going from, say, 6% or so core inflation in the US to around 4% or so where we are now was the easy bit, because that was addressing the supply chain bottlenecks, satisfying that initial pent-up demand post-lockdown. Again, relatively easy to do. But especially when you think about the fact that inflation has been so high for so long, economists talk about inflation becoming entrenched. We become used to it, we expect it. And if, to some degree, if you expect inflation to occur, it kind of occurs, or at least that's the theory. So you're absolutely right, inflation expectations perhaps are higher than they were before, longer term. And then in addition, if we think about the different components of inflation, goods inflation, services inflation, there are certainly reasons to think it actually is perhaps going to be higher than it was before.
One more known unknown, and that's politics. It's not going to be just about the presidential elections in the US, but of course it is going to be a significant factor. Some even claim, and I do subscribe to this theory, that it might somehow influence the Fed's decision making. How do you read that? We're going to have 70 elections across the world, some of them really important, some of them already are done, like the one in Taiwan. Is it something to follow this year? Of course, every year politics plays a certain role, but this year seems to be significant in this sense, at least statistically.
Yeah, absolutely. Well, there are two challenges. So one is often geopolitics don't matter until they do. Meaning there's always risks, but when it actually materializes. So as an example, for example, people are understandably concerned about relations between China and Taiwan, but if you look at emerging markets, Taiwan was the best performing emerging market last year. So yes, certainly a geopolitical concern so far has not impacted the market. So we don't want to get too carried away on one hand, not investing because we're worried about all the risks. The other challenge is identifying when those risks are macroeconomically important. And here an illustration is what's happened in Russia and Ukraine. I mean, typically these types of conflicts, however bad they are, don't have a global macroeconomic impact, but absolutely this did, and that was because of Europe's dependence on imports of natural gas. So it was unusual insofar as there was a very obvious, significant economic link. So when you look at these geopolitical risks, you also need to ask the question, depending on the outcome, is this going to change investor behavior? Is this going to change consumer behavior, or change some part of the macroeconomic picture? And that's when you might see, well, yes, this could matter, and I need to pay a bit more attention to it.
Right. So to sum it up, how should the winning portfolio, let me put it this way, for 2024, at least the first half, should look like? What would be your call?
Well, I can share with you our current allocation and our multi-asset portfolio. So we're broadly neutral on equities, with an underweight to Europe. So sharing some of those concerns about the outlook for Europe, kind of see, unfortunately, more negative factors than positive ones. Nonetheless, a neutral allocation on equities, would be good, meaning if you have a historically average return on equities, I think we'd all be pretty happy with that. So neutral on equities broadly. And then on fixed income, our primary overweight actually is to inflation-linked bonds in the U.S., TIPS or real yields, in anticipation of real yields falling as the Fed cuts rates and as U.S. growth slows. So that's probably our key position expectation. We also like investment-grade corporate bonds in the Eurozone. If you look at spreads, they're still comparatively high, though they've come down quite a bit. And we also do like local currency emerging market debt. We still are looking for yield, and it's an area where we think the yields are attractive and are less concerned about them going up significantly from here.
When it comes to stocks and geography, you mentioned Europe, you mentioned the US. How about Asia, and especially China, which is experiencing still a fairly significant sell-off. I mean, Hong Kong is in 2-decade low.
Yeah. Well, this is where, not so much geopolitics, but identifying the fundamentals versus sentiment, because you could argue that what happened this year, certainly to some degree, has been fundamentally driven insofar as the recovery in earnings we anticipated at the beginning of the year has not materialized, and then you're now trying to anticipate if and when that will happen. But that said, consensus earnings growth expectations for China for 2024 are around 16%. So, you at least hope to get quite strong earnings growth. And then given how much the market has underperformed over the last several years now, on a relative basis, valuations do appear quite attractive. So from a fundamental point of view, really it should do well, but we appreciate there are many other variables in that equation that are going to be quite important as well.
Říká hlavní tržní strateg BNP Paribas Asset Management Daniel Morris. Daniel, very interesting indeed. Thank you.
Thank you.